Hi guys, what we're going to talk about today is the capital review of RBNZ. So our point is that we agree the RBNZ's proposal to increase the bank's capital. So basically, the banks is defined as the financial institution that provides banking and other financial services to their customers, such as accepting deposits and providing loans. So bank's capital is the first to absorb losses to the bank, represent the equity value of the bank to investors. The asset portion include cash, government securities, and the interest earning losses.
There are 5 advantages of increasing capital to bank. Firstly, the more capital a bank holds, the more the owner have to lose, the more carefully the owner will manage the bank. Secondly, when bad debt increase, the more money the bank has, the bank can stand to lose before going out of business. Thirdly, when there are more capital available for bank, then there is a decrease in capital requirement. It means other rules and monitoring of banks' activity will need to be much shorter. Fourthly, the more capital a bank holds, the less chance the bank fails. Lastly, increasing capital to bank will less costly at bank crisis. When a bank failure happens, people will lose confidence, become unable to plan their future. The loss of confidence and a growing sense of insecurity. Overall, by increasing capital to bank, it will result in a better bank performance, better protecting deposit, decreasing cost of monitoring bank, preventing bank from failure, and less costly at financial crisis.
However, there is certain disadvantage of increasing bank's capital. For example, this is bank's original capital, and this is bank's original deposit. Capital is not profitable and deposit is profitable. Now, if we increase the capital, the deposit will decrease, which means the part that bank can own profit will decrease. So the main disadvantage is that bank will earn less profit if capital increase. For bank, increasing capital certainly increases stability. So with more capital ratio here, bank is more stable and more solvent. Depositors and creditors will be more confident in bank because it is not likely for the bank to fail in a financial crisis. This will increase bank value. But now let's look at point here. This is when bank has too much capital. The expected output is actually very low. This is because bank only have a very little volume of deposit and it cannot earn much profit. Therefore, if the capital is too high, it will actually decrease bank value. So what we need to do, we need to find the appropriate ratio here to balance the advantage and disadvantage to achieve the highest bank value with stability.
Also, New Zealand is bank-based economy. Its financial system is dominated by the banking sector. New Zealand's big 4 banks are all Australian banks, and its biggest industry is the agriculture sector, which means New Zealand's economic system is too simple and not enough diversified to support its economic development. Meanwhile, as New Zealand is an import country, it will be affected by the international economy easily. Therefore, New Zealand is highly dependent on its bank system, and somehow the stabilization of the banks decides the stabilization of the whole country. As we said, New Zealand is not a self-sufficient country. It relies on the imports, so the stable international economy is important to New Zealand. But now, the world's economy is not steady. For instance, the intense trade war between America and China and Brexit. Thus, New Zealand may more urged than other countries to prevent the future economic crisis that could happen. In conclusion, New Zealand ought to ensure the steady bank system instead of earning profit. So we are in favor of the RBNZ proposal.